All right, it's right at the bottom of the hour. Welcome, everyone, and happy Wednesday. My name is Colin Evans, and I'm part of the business development team here at Baird. On behalf of your Baird advisors, I want to thank you for joining us for today's Baird Wealth Strategies webinar entitled Building a Flexible Retirement Income Strategy. Retirement income planning is about more than just saving. It's about understanding where your income will come from, how it aligns with your spending goals, and how key decisions, especially around Social Security, can impact your long-term financial confidence. Today, we're going to be reviewing common sources of retirement income, discussing how to prioritize expenses, and spending significant amounts of time on Social Security fundamentals, including when to claim benefits and planning considerations for couples. Then we're going to bring it all together and discuss how a coordinated plan can help support flexibility throughout your retirement. Today, we're joined by two of our distinguished wealth planners, Matt Urbanic and Ron Johnson, who will be presenting this valuable information. But before I turn the call over to Matt, I'd like to quickly review a few housekeeping items. All participants are currently in listen-only mode. However, we encourage you to engage by submitting questions throughout the session. You may submit questions by clicking the Q&A icon at the bottom right of your screen. Please ensure that your questions are directed to all panelists. Today's presentation is expected to run approximately an hour, allowing ample time at the, 50 minutes, allowing for ample time at the end for questions. If you have timely questions related to specific slides, we may address them periodically during the presentation. As a note, this presentation is being recorded, and along with the slide deck will be available through your financial advisor approximately 1 week after today's call. And with that, I'm going to go ahead and turn it over to Matt.
Thanks, Colin. Audio's all right. Everyone can hear me okay? Perfect.
Yes, sir.
I'm going to hop right into the agenda. We have a pack full of agendas, so I want to go ahead and get started right away. Again, today's presentation is going to start out by really making sure that we can identify the different pieces of the puzzle when it comes to being able to recreate an income, a paycheck in retirement. To me, it tends to be the most common question that I see as a wealth planner from clients. Two questions I get often. First is, do I have enough money to retire? And the second question then is, well, where am I going to get my paycheck from? So we're going to dive in today to talk about that second question of kind of how are you going to be able to recreate your paycheck when the time comes in retirement. So I'm going to start out by identifying what are the different sources of retirement income you could be looking at. How do we match our income to our expenses, short-term, mid-term, and long-term goals? We'll talk a little bit about the fundamentals of Social Security. I'm going to hand it off to my partner, Ron, who's going to talk a little bit about when to take benefits and some spousal planning strategies and being able to help put all of these pieces together. So as we start out, sources of retirement income, every person's pieces of the puzzle are a little bit different. I can tell you I've done thousands of financial plans in my career, and no two looked identical. No two financial plans, no two components of those financial plans were ever the same as a client as well. So when we talk about building an income plan in retirement, there is really no magic. Here's how you do it because everyone's the same. Everyone is a little bit different. And that's why when you take a look at these key components, what you have and what sources of income you have are going to vary completely from your coworker, from your neighbor, from your siblings, from your brothers, sisters, other folks who may have goals and visions of what their retirement should look like as well. So no two resources are the same, and no two goals and objectives are the same. So again, oftentimes I refer back to this sort of FOMO. We hear other people are doing certain things or are employing a certain strategy. Should I be doing this myself? Again, I look at it and say, your situation is oftentimes different than someone else's. So keep in mind, there is no standard way to create income in retirement. But you hear the old adage of again, accumulation versus decumulation. And today we're going to focus a lot on the decumulation, which is when I get to the top of the mountain and I'm ready to retire, I'm ready to start going downhill, oftentimes it's the trek down the mountain that is more dangerous and more complicated than the path that we took up the hill to get to retirement. So as we start out today, again, different sources of retirement income. Again, they can come from a different variety of sources. For most people, that comes down from the form of IRAs or employer-sponsored plans, 401ks, 403bs, TSPs, 457s. Additionally, you may have taxable portfolios, stocks, bonds, mutual funds with your Baird advisor. You also may have a pension, although they're becoming rarer and rarer, kind of going the way of the dinosaur. As pensions become rarer and rarer, we have more focus on being able to generate portfolio income to be able to do what we want to do in retirement. There are annuities, there are part-time work, and there are things like rental real estate as forms of ways to create stable income in retirement. When we talk about income and generating income, the important thing is that we also keep an eye towards taxes. Every resource, every piece of the puzzle may on the surface look like it's a certain net worth component for you. But when we talk about Uncle Sam, he always wants his fair share of pretty much every investment. So we have to also take into account taxes when we determine what's the most flexible way for an income strategy. So I start out oftentimes the fundamental foundation of an income plan is looking at what are the sources of the guaranteed income that you have. And again, in the base of this pyramid, that's the Social Securities, the pensions, annuities, part-time work, rental real estate. Again, all of these things I'll point out are as stable, or as I use the air quotes, guaranteed as the source that provides them. So for instance, Social Security is as guaranteed as the government providing us that check. Our pensions are guaranteed sources of income, but it's guaranteed by our employer. Annuities are guaranteed. They're guaranteed by the insurance company. The part-time work is the ability for us to continue to maintain maybe a hobby work in retirement if we want to, whether that's working at the golf course and as a starter, or working at the craft store, or working at Lowe's or Home Depot. And obviously rental real estate is only as guaranteed as having good tenants. Anyone who knows and has had rental real estate, again, tenants cannot always be guaranteed with the paycheck that you may have as well. So we start out and say that builds the fundamental foundation of our income plan by the sources of things that are going to hopefully pay us every month. Built on top of that is a combination of any of these four quadrants of investable assets. For most folks, it comes down to a heavy reliance on qualified retirement plans. And there are tax-free assets, things like Roth 401ks, Roth IRAs, as well as HSAs if used for qualified healthcare expenses. Again, HSAs I think are a really great vehicle that are underutilized for many folks. I think of my HSA as my healthcare 401k. I'm not tapping into that or touching that or taking money out of it every year to pay my current expenses, because it's more valuable to me in retirement when I'm trying to keep my income low. So there are certain components on this that are more tax efficient, Roth 401ks, Roth IRAs. Again, I would say tax deferred, I would say less efficient in retirement, not necessarily less efficient while you're working. Obviously, the theory with pre-tax IRAs or pre-tax 401ks is you're going to avoid paying current taxes to pay future taxes when you take money out in retirement. As a reminder, that tax-deferred assets, the pre-tax 401ks, pre-tax IRAs, and some annuities are subject oftentimes to required minimum distributions, either at age 73 or if you're born after 1960, required minimum distributions now are pushed out to age 75. The tax-free components, Roth IRAs, HSAs, don't have those required minimum distributions out of those accounts. Again, in determining where and when to take certain aspects of this, it's a balance of this. We have two congruent tax scenarios that we're working through at any given time. So the more tax efficient, less tax efficient line, that tax deferred assets, when you take money out of a 401k or an IRA that is a pre-tax, you are filling or paying ordinary income brackets. Ordinary income, much like when we're working, ranges from 10% at a low to high of 37% on a federal level. If you live in a state that has state income tax, that is then on top of that. So as much as you deferred that tax while you were working, you will have to pay that tax when you take money out. On top of that is capital gains brackets, which are more tax favorable. So when you think of capital gains items, usually you're paying a combination of either a 0, 15, or a tax of 20%. Again, those top investments, the taxable non-qualified investments, are going to usually be taxed at capital gains rates. They're a little bit more preferred than ordinary income rates. But that's not always the case. It's usually when you are decumulating and being able to recreate your paycheck in retirement, it's likely some combination of all of these things being able to generate that paycheck that's most tax efficient for you. As an example, if I have a goal and objective that says, you know what, I want to buy a condo, that's $500,000 that I need to pay out, and I want to pay it for in cash. If I take it all out of my pre-tax 401k, that's entirely taxed at income. And I kind of might have just defeated the whole purpose of why I did pre-tax in the first place, which was this theory that I would pay less taxes in retirement to take that out. So that's oftentimes a good situation where we may fund that with a Roth account, or we may fund larger expenses maybe with qualified or non-qualified accounts that have low basis, and there's less taxes being taken out that may not come entirely from just a pre-tax account as well. So moral of this story is there's different tax implications for how you create your paycheck, but each person's component and each piece of this puzzle, each piece of this pyramid is different from client to client. So it always starts with, for me, defining how much you need. Any financial plan that I've started is always tell me how much you think you need every month to fund your lifestyle that you want in retirement. And usually when I ask questions of a client, the question becomes, do you want to live the same lifestyle you're living today? Do you want to live more of a simpler lifestyle? Hey, we're going to retire to the cabin and I want to do crosswords and Sudokus all day, and that's going to be my level of fun, and I maybe need half of the income that I have today. Or is your goals in retirement to be a little bit more spending than what you're at today? Have more objectives, do more travel, do more things, have a golf club membership, all those things that maybe cost a little bit more than what we're living on today. I would say on average, most people tell me, yeah, at least give me what I start with today. Give me the paycheck and the lifestyle I have today. If I can have more than that, great. So we often talk about where's a good starting point. It's take a look at what you have today. What is your take-home pay that you can live and spend on? And that's oftentimes saying, all right, if we start there, can we recreate that amount to make sure that you can maintain your existing or current lifestyle? And here's an example of how you would do that. Again, if I have $100,000 gross wages, I'm putting $10,000 into my 401k. Uncle Sam takes his $20,000. I have a $70,000 net take-home pay. I'm then saving an additional $10,000 outside of my employer plan. I'm putting money into my IRA or my taxable non-qualified savings accounts. Well, then I have $60,000 left. If I want to maintain my existing lifestyle, well, then $60,000 is my goal. However, we normally see that most folks, when you cut out the things like having to pay dry cleaning or travel or commuting to work or some of the other employer-related expenses, it usually ends up being somewhere about 80 or 85% of your take-home pay that you end up having to sort of have as a number for a goal. So this is an example where somebody who had $100,000 of gross wages, their starting point was somewhere about $48,000 or $4,000 a month to live the lifestyle that they want in retirement. And this number is going to be different for every person. Your situation, your bills, your expenses, your goals are going to what defines this, which is where, again, we want to make sure that we can identify what are your essential expenses. When you think of things that are essential, obviously keeping a roof over your house, keeping the taxes paid, keeping gas in the car, keeping groceries on the food, keeping the prescriptions filled. things that are non-negotiable. All right, so we'll start out and we take a look and we start to be able to write down what are our essential expenses. The second thing is what are maybe some of our flexible things, things that give meaning to your retirement, things that you really want to do, your hobbies. Maybe it's the golf club membership, maybe it's the entertainment, the things that you want to do that when you look forward to retirement, those purposeful things that you are looking forward to, um, those we put in that flexible expense category. And then the third thing are what are the discretionaries? They're the goods to haves, they're the I wishes, but if we really had to make a decision on cutting certain things, we would be able to want to look at cutting out those discretionary things like travel, gifting, going out to eat, charitable giving. These are kind of the lower priority things that if we had to, would likely be things that we would pull out of our budget when we get to retirement. So I break these down into 3 different classifications, and we talk about one of the most sufficient ways to be able to talk about bucketing expenses in income. If we really want those essentials, again, the mortgage, the taxes, the insurance, those essential living expenses to be able to be covered by your guaranteed sources of income. So things like, again, your Social Security, your pension, any form of annuities. And the thought process here is I don't have to wonder by looking at the market if every month I have enough to be able to cover my essential expenses. I'd like for those to be able to be completely guaranteed where I can. Again, the second thing is those flexible retirement expenses, those things that give us meaning and purpose. Again, those are where we look at things that are income generating, things like CDs or bond ladders or dividend paying stocks. We know that CD rates, bond ladder rates, and dividend rates can vary from time to time. They aren't consistent or guaranteed. Dividend rates go up, CD rates go up or go down as well. So the flexible retirement spending are those things that we hope will be able to give us some form of consistent income, but it's not guaranteed. So I think through being able to generate income from my investment portfolio for the things that give me purpose and meaning. So those are the things like, again, the country club membership, the entertainment, the golf, the crafting, those types of things. And then lastly, the discretionary retirement expenses. Those discretionary retirement expenses are really where we focus on the investment side of the things, the stocks that may go up, may go down. Again, if I think of that as, hey, in a good year, markets have gone up, we feel really good, cashing out some of our stocks to buy that family vacation. You know what? We're hitting a potential recession and things are going down. We don't want to sell down. You know what? Maybe we push that family vacation out another year. The flexible nature of some of that discretionary spending allows us to look at those things and not have to sell out of investments when the markets potentially take a dip. So here's where I would say just an example of 2 potential clients who have 2 different spending goals. The first one on the left, client who has about $100,000 per year spending goal. And you look at their components, their pieces of the puzzle that build their income plan. They have $50,000 a year of Social Security between husband and wife. They have $30,000 a year from a pension. And then they have to fill an additional $20,000 per year from their IRA or from their 401k that they rolled over into an IRA. So in this case, this client's income is 80% guaranteed, and that $20,000 is the only thing that's really driven by market forces. Versus on the right side, the client who has a $200,000 spending goal, more, actually a little bit higher number on the Social Security, 60,000, no pension, but they have a dividend paying income, they have some bonds in their portfolio, and they also have IRAs, taxable portfolio withdrawals. I look at these 2 things, again, left versus right. The left, again, has 80% of their income coming from guaranteed sources, sort of 80% of their goals. The right side, it's really only about 30%. And you start to see that the higher our wages, the higher our living expenses, our goals, the higher the the income goals that we have, the more we have to rely a little bit more on the investment side of things. And that's, again, the bond interests, the dividends from the portfolios, as well as withdrawals from our qualified accounts. With that being said, again, I look at both of these situations, and both of them have one commonality. Actually, they have two, but one big commonality, and that is Social Security. Social Security is the building block of every individual's income plan. I don't know if I've met a client, met clients who have $100,000. I've met clients who have $100 million. They all want to know one question: how do I get the most out of Social Security? What is the right claiming strategy for me and for my spouse? So we're going to dive in, spend some time reviewing kind of the fundamentals of the Social Security, but more importantly, we're going to talk about some spousal claiming strategies that can help us to determine, between me and a spouse, what's the best thing for not just me, but what's the best thing for we. When you have a conversation between a filing status for a husband and wife, or for a married couple, again, it's usually a decision of between the two of us, what is best for both of us. So we'll dive in here on the fundamentals of Social Security. As a reminder, Social Security has eligibility requirements in order to receive your own benefit. You're going to hear us talk today about your own benefit, spousal benefits, and survivor benefits. Again, those are three completely separate benefits. But in order to have your own benefit, you must have 40 quarters of taxable earnings to be eligible for benefits. You earn 1/4 of earnings for Social Security per $1,890 of earnings that you earn this year, and you can earn up to 4 quarters per year. So it is basically 10 years of quasi work record in order to earn your own work record. Worth noting that this does not apply to spousal benefits or survivor benefits. This is only in order to you to achieve a benefit on your own. Social Security is based off of your top 35 earning years. It's not your last 3, it's not your last 5, not your last 10. It is your top 35. Why that's important: oftentimes I have clients come to me and say, hey, if I start to work part-time, or if I start to slow down a little bit, doesn't that change my Social Security? Not if it's not one of your top 35 years. If you have a full work record where you have 35 years of earnings, your part-time work or your casual work as you transition into retirement is just not going to knock off one of the other lower waging years. So again, your top 35 remains your top 35, so it will not decrease your Social Security. Again, in 2026, your max includable credible earnings is $184,500, which means whether you make $1 million or you make $184,500, you pay the same. Anyone pays the same for the $184,500 or over. That being said, because they cap the earnings on what we pay into Social Security, they also cap the benefits. The formula that they use is a very, very complex formula, more heavily weighted towards your like first $30,000 or $40,000 of earnings. Becomes less and less as you start to go up your wage scale. But the max benefit at full retirement age, so at age 66 or 67, is $4,152 per month, or just shy of $50,000 per year. That is the age 66 or 67 full benefit. As we'll see, you can grow that by delaying your benefits all the way up to age 70. So as we mentioned, Social Security, full retirement age, this is the age that you will qualify for your own benefit at 100%. So if you hear me talk about a 100% benefit, that is your primary insurance amount, or your PIA. It is the number that when they're highlighting on your Social Security statement, it's the age that you qualify for your full retirement age benefit, or your primary insurance amount. This is the last year we have to worry about 66 and 8 months or 10 months from 1960 or later, or starting next year when everyone turned 67 in 1960. We don't have to worry about if your full retirement age is some form of a month. But right now, again, these are the full retirement ages based upon your dates of birth. A lot of times you talk about being able to start benefits early. And as a reminder, taking Social Security before your full retirement age, before 67, in this example, does involve a permanent reduction in benefits, all the way down to 70% of your benefit if you took it at age 62. That does not go up once you get to age 67. It'll go up by small cost of living adjustments every year, but in years that your cost of living is potentially zero or small, you will never earn back your 100% benefit. The only way you get 100% is by taking it at your full retirement age. You also have the ability to enhance your benefit. So delayed retirement credits allow us to be able to increase the amount that you earn off of that 100% benefit by 8% more per year. So in this scenario, somebody whose 100% primary insurance amount is at age 67 actually has the opportunity to grow it up to 124%. So if I go back to this example where the maximum benefit payable for somebody in 2026 is $4,152 at age 67, an additional 24% is $1,000 and I believe $38. So it could go up to $5,200 is the maximum that anyone can get should they wait all the way out to age 70. So let's talk a little bit about working. I talked about some of the fundamentals income plans that we have, and part-time work was one of that. Oftentimes you get the question in regards to, should I file for Social Security while I'm still working? Or can I, retire, take Social Security, and then do some casual part-time work? There's some good things and there's some bad things. There's some uppers and there's some downers here in this case. The uppers would be that if your earnings while you work part-time in retirement prior to your full retirement age. So if you file for benefit at age 62, 63, 64, 65, or 66 for most people. If you claim before your full retirement age, you do have earnings caps or earnings restrictions that may reduce your benefits if you continue to work while taking Social Security. So the top benefit here, the current amount in your orange box here, says that if you are working and you are under your full retirement age and you make more than $24,480, that's the number here in 2026, these are indexed for inflation, you will see your benefits reduced by $1 for every $2 earned over that threshold. I will point out that this is only for filing prior to full retirement age. If you are 67 or 68 or 69 and you want to turn on Social Security while still working, these earning limits are not applicable to you. It only if you apply prior to your full retirement age. Talk about the reduction amount here. If, however, you continue to work and take Social Security and that wage that you earn is one of your top 35 years, you may actually see an increase in benefits in future years because your benefit amounts are recalculated for every year that you continue to work and earn wages. I will point out this is an example. I don't want to get too deep into the weeds here on this one, but know that again, it used to be that when you were taking Social Security before full retirement age, if you made more than that $24,000 number, they withheld your entire Social Security checks to start the year. So in this example, somebody who has a $1,500 a month benefit who lost $6,000 of benefit because they made $12,000 more than the earnings cap, previously, they would have just missed 4 straight months of paychecks. We would have gotten zero from Social Security for 4 consecutive months until that earnings excess was essentially withheld. They have made revisions of that. In 2024, there was a revision to that rule that says now, if you make more than your sort of earnings restrictions, they're going to withhold 10% of your benefit until that amount is withheld. So in this case, as an example, somebody who has a $1,500 per month benefit would have $150 per month withheld until the $6,000 of excess benefits are paid back. So 40 months. Worth noting here that that's going to continue even if you are beyond full retirement age. So it's going to take this individual 40 months, so almost 3.5 years of that reduction because they were earned more than the earnings cap while collecting Social Security. As a reminder, again, this is only if you take Social Security while working before your full retirement age. Talk a little bit about how Social Security is taxed. Again, there is a formula here, which is provisional income, that determines that up to 85% of your taxable income, up to 85% of your Social Security is includable in your taxable income. I want to make sure I clarify here. It doesn't mean that your Social Security is taxed 85%. I've gotten that a couple times. It just means that you get 15% of your Social Security for free. The other 85% of it is part of your taxable earnings when you go to file your taxes every year. I will note here that over $44,000 is where you start to see 85% of your Social Security includable in your taxable wages. This bracket from 32 all the way up to 44 has not been updated since I believe 1992. So this was one that is not indexed for inflation for as long as I've been giving this Social Security presentation. These numbers have been the same. But Matt, Social Security is taxed? I thought I read something that there was a tax bill that was passed last year that that said that Social Security is no longer taxed. That's what I thought I heard. Not technically. I want to make sure that we clarify that. In the 2025 OBA tax bill, there was a $6,000 exemption provided for seniors, defined as those who are age 65 or over. And you only have to be 65 for one day in the tax year. So if your birthday is December 31st, you get this deduction on December 31st. It applies for 4 years. So once was last year. So if you're filing your taxes, that's included in the taxes for this year, and then 3 more years beyond that as well. However, worth noting, it is not tied directly to your Social Security filing status. For example, you could be age 62, take Social Security early at that 70% number, and you're not really going to be getting that enhanced exemption. You're still going to be taxed fully on Social Security. On the flip side, you could be waiting until age 70 to get your Social Security. So you go beyond age 67, and you still get that, even if you're not filed for Social Security. So worth noting that exemption is basically for those over 65, and it's not tied to your Social Security filing status. I had a client ask me, should I file for Social Security so I can get this additional exemption? It doesn't matter if you're filing for Social Security or not. You get that exemption if you're 65 or over. Worth noting, it does phase out for higher incomes, so keep an eye with that. Talk to your tax professional about if you qualify for that additional exemption. So with that, states tax it as well. There are a couple states that do tax Social Security. We're down to 8. This is becoming less and less. West Virginia was the last one last year that made some changes. If you are in Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, your Social Security will be subject to some taxation. So both from a federal as well as on a state level. Talk about the Social Security Fairness Act. If you are a police officer, a firefighter, a teacher, somebody who was subject to a public pension, it used to be that if you were on a government-sponsored pension, you were subject to what was called windfall elimination provisions or government pension offset. That significantly reduced the amount of Social Security that you or your spouse could collect if you had your own benefit as well. That was repealed back in 2024. So if you are on a government pension and you have work that you have paid into Social Security and achieved your own benefit, it is no longer withheld or reduced due to these 2 types of provisions. How to apply for benefits. Again, you can apply up to 4 months before you want them to start. benefits are paid 1 month in arrears. So for instance, if I want benefits to start in July, I can apply as early as March, 4 months before, but I'm not going to get my first paycheck until August. So my July paycheck gets paid in August. So it's always 1 month delayed. Again, best way to apply online. You don't have to worry about the large call times. SSA.gov. If you haven't already, highly encourage everyone, get an online portal set up at SSA.gov so you can view and or apply for benefits there. You can always call. I always encourage folks, avoid peak call times. Peak call times are right away, first thing in the morning. Peak call times are lunch. So like 10 and 2 are sometimes the best times to avoid large call times there as well. All right, so I am going to hand it off to my colleague here, Ron Johnson, who's going to talk about when did you take benefits and what are some strategies around spousal benefits that we can help better understand how spouses can file for benefits together. Ron, back to you.
Awesome. Thanks, Matt. So, you know that Social Security loves their initials and acronyms and all of that. So when it's time to claim your benefit, what you're going to do is you're going to go to SSA, probably at your FRA, to claim your PIA. But if you wait, you could get some DRCs, LOL. Now, I'm not sure exactly what all that means, but if you're on the call and you're a millennial, we probably do. But what the point is, we'll try and keep this as simple as possible for you. So here's the deal. There's a myriad of ways to claim your benefit. You can start as early as 62, and you can wait as long as 70. And the question is, well, what's the answer? What makes the most sense? And there's lots of things to think about, and we'll unpack that for you today. But really, the way I look at it is the longer you live, the more likely it is that you would benefit from waiting to age 70. If you expect a shorter lifespan, it's probably better off. You're probably better off taking it sooner than later. Now, we have to worry about working prior to your full retirement age. But likely that's probably the answer for you. Because Social Security, they have a room full of actuaries that try and figure this all out. And the reality of it is if you look at your benefit, and let's look at this example. You look at your benefit. If you claim at 62, you can get $1,400 a month. If you wait to 70, you can get $2,480 a month. Much more, over $1,000 more. But the question is, how long does it take for my larger age 70 benefit to make up for the fact that I didn't claim benefits for 8 years? This chart actually lays it out pretty good. If you look at age 80 here, you're pretty much breaking even. If you live longer than that, your extra $1,000 a month by waiting to age 70 is going to start to be fairly lucrative for you. So that's a pretty basic way to look at it. Now let's start with spousal benefits. Let's talk about that because this is incredibly important. Now, Congress recognized early on that there's value to staying at home and not working, caring for children, doing all the household things that need to be done. So you're going to get a Social Security benefit, and it's going to be based on your working spouse. Now, not only does the spouse, can they receive benefits, but ex-spouses, and we're going to talk about that. And there's benefits for when you outlive your spouse. And when you outlive your ex-spouse, there's some benefits there as well. Now, if you're parents, if you're caring for them and they're a dependent of yours, they can also receive part of your Social Security. And so can children. If you still have minor children, you had children late in life, and they're still under 17 while you're claiming Social Security, or 17 or under, they get some benefits too. So we have to think about that as well. All right. Let's start with the spousal benefit. So the spousal benefit is essentially half of the working spouse's benefit. Okay? So let's unpack that a little bit. So first of all, we're now operating under what's called the deemed filing rule. What that means is when you apply for benefits, you've applied for both your retirement benefit and your spousal benefit, and you're going to get the larger of the two. Now, with spousal benefits, you can't claim spousal benefits until the other spouse has claimed theirs. So you'll either get no benefits until they claim their benefit, or you'll get your retirement benefit, and then when they claim their benefit, you'll switch to the larger of the two. So the cool strategies of file and suspend and the restricted application are gone, unfortunately, Matt. Okay, so like I mentioned, the spouse will receive either their the spousal benefit or the working benefit, and there's also a benefit for the surviving spouse. Now that benefit is going to be 100% of the deceased spouse's benefit or your own retirement benefit, which is ever larger. Now there are some unique strategies here with this one, so I want to take a minute and unpack that. So if your spouse passes away early, they forgot to look both ways when they cross the street. Here you can receive the spousal benefit or the survivor benefit and let your own retirement benefit continue to grow and collect that at a later date. Or vice versa. You could go ahead and claim your retirement benefit if the survivor benefit is larger and let that grow and claim that at a later date. So what's the right answer here? We'll help you figure that out. If this situation impacts you, we can look at the numbers and figure out what's the best combination here. And we'll help you with that. So in the interest of time, I'm going to move a little quicker. So I apologize for that. But if this does generate some questions, we'll try and tackle those. Now, surviving spouse eligibility. I don't love the title of this slide. Because quite frankly, eligibility is you're alive and your spouse is not, and you're over 60. Now, there's a couple other rules to that as well. But now, let's say that you're an ex-spouse and you were married to your ex-spouse for at least 10 years and you've been divorced for at least 2 exceptions there. You are eligible for a spousal benefit if it's larger than your retirement benefit. Now, the rule here is that you can't have remarried before the age of 60. Well, I'm sorry, wrong rule there. You could have remarried. In fact, if you remarry every 10 years and try somebody new, you get some options here. You get the best of the benefits. Whatever ex-spouse you had that had the most of Social Security, you get to pick that one. Just don't get divorced. I'm sorry, you can't get divorced. Boy, even I'm tripping on that constantly. You can get divorced there. Okay. So multiple ex-spouses, you get the larger of the two. Now, if you're Kobe Bryant and you had multiple ex-spouses or other NBA players, and I don't mean to pick on NBA players, but I tend to pick on NBA players. All of your ex-spouses will be eligible on your work record. Now, this has no impact to you. And unlike spousal benefits, ex-spouse benefits, you don't have to, the working spouse does not have to be claiming the benefit for you to be eligible. You can simply go and claim the benefit of your ex-spouse and they'll never know you did it. Okay. Same thing with surviving ex-spouses. If you're alive and your ex-spouse is not, you can get a survivor benefit as well. And that's, again, same as the spousal survivor benefit. It's 100% of their retirement benefit. And you can claim that if it is indeed larger than your own retirement benefit. Okay, let's take a look at a few examples so we can understand how all of this interplays with each other. So let's assume that spouse A earns his benefit is $2,000 a month. His primary insurance amount, which is what you can receive at full retirement age, for most of us will be age 67, is $2,000 a month. And spouse B is $1,500 a month. In this example, if this couple claimed at age 67, FRA, spouse A will receive $2,000 a month and spouse B will receive $1,500 a month. No spousal benefits here because the retirement benefit exceeds it. Now let's change this example a little bit. Same situation, but now spouse B, their benefits is only $900 a month. So if they claim at full retirement age, spouse A will still get the $2,000 a month, and spouse B will receive their $900 of retirement benefits, and they'll get an additional $100 a month to bring them up to 50% of spouse A. That's how that actually works. So essentially, they'll get a spousal benefit here that will be half of the spouse A's retirement benefit. Okay. Now let's look at this. Let's say we decide to claim early. So spouse A goes ahead and claims at 62, and her benefit falls to $1,400 a month. Spouse B goes ahead and waits to age 67. And so spouse A receives $1,400 a month, spouse B waits, and when they reach their full retirement age 67 for them, they'll receive $900 a month for the retirement benefit, and they will still get the full half of spouse A's primary insurance amount, so they'll still get the other $100 a month. So that does not impact them because spouse A went early. Now, let's assume that both went early. Nothing wrong with that. Not really. So spouse A is $1,400 a month. And spouse B, their benefit falls to $650 a month, their retirement benefit. Now, essentially what they're eligible for is, at this point, half of spouse's A age 62 benefit, which is $1,400 a month. Half of that brings it down to $700. So they would get an additional $50 on top of that for a total of $700. Now, let's talk about age 7, how this one works. So spouse A, their PIA, primary insurance amount, is $2,000, but if they wait 3 years, it grows to $2,350 a month. Now, spouse B, their benefit is $900 a month, and if they wait, it grows to $1,150 a month. If they each claim at age 70, guess what? Spouse A gets the $2,350 a month, and spouse B gets the $1,150 a month because it's more than half of the primary insurance amount. So, no spousal benefits. Okay. One more example here. Let's see. Did the slide move? Let me see. Okay. Well, that's okay, because we're running short on time. So, in order to make a decision, you need to know how much it is. You can simply go to the Social Security website. They have lots of calculators there. You can calculate a myriad of different options based on future earnings and so forth. It's actually very handy, a very good tool. If you have more questions on this, ask your advisor and we can walk you through that. Now, you also can get a copy of your statement on the website. Your statement in this box here will give you what your estimated benefit in today's dollars will be from age 62 to age 70. Now, they assume that your last year's earnings continue on until full retirement age. That's how they calculate this. So it becomes very important to look at page 2 and look at what your earnings history is. There occasionally are errors that are made here, so it pays to take a look at it, okay? All right, moving on. The calculators are great. SSA.gov, that's the Bible. That's the horse's mouth, as they say. So go there for the calculators and other information and to sign up as well. Now, I went really fast through all of this. But claiming a real claiming strategy, we're going to look at 2 things. One, what's the best combination given a certain amount of assumptions that we can get the most possible from Social Security given over our lifetime? Then we layer on, how does the claiming strategy impact your tax strategy? Is it better to wait to age 70 so we can realize other sources of income in the meantime? A lot of times the answer is yes. So those are some of the things as a financial planner that Matt and I think about. With that, as Matt alluded to earlier, Social Security is a very important part of your retirement plan. So we will work with you to figure out how best to meld your Social Security benefit into your financial plan. And with that, Colin, I'm going to send it back to you. We may have some questions, so I've left a little bit of time to address those.
Yes, thank you, Ron. Thank you, Matt and Ron, for sharing your insights with us today. We have seen some great engagement from our audience. And just as a quick reminder to the audience, if you have a question you'd like to ask, please use the Q&A icon located at the bottom right of your screen. And when submitting your questions, please address it to all panelists to ensure it's properly routed.
I'll take a couple of the ones that I saw come through the queue just to kind of highlight a couple of repeats. The detailed budget worksheet, I put a link to that in the Q&A. So if you wanted to be able to start with taking a look at what your expenses are, it's always a great first step in getting ready to retire, to start to identify what those expenses are. I put a link to that in the Q&A. Yes, the presentation, if you wanted to reach out to your Baird financial advisor, they can get you a copy of this. It also will be a recording of this session, as well as the deck will be available in about a week's time as well. A couple things around spousal benefits and survivor's benefits. I actually had this happen myself. My mother-in-law passed away last year, my father-in-law. Difference in terminology that even Social Security Administration themselves sometimes can confuse is that spousal benefits and survivor benefits are technically 2 different types of benefits, although they are oftentimes off of a spouse's earning records. If you go after a spouse passes away, you are eligible for the higher of the 2 benefits. You don't get both. So if you go to Social Security, you'd say, hey, I'm here to file for my spousal benefits. They're going to start thinking about that 50% number that we are talking about. Oftentimes they confuse it themselves. It's very clear that I had to actually go back and forth with Social Security 3 or 4 times myself on we are applying for survivor's benefit, which is to step up the surviving spouse's benefit to the higher benefit amount. So different terminology there that they themselves oftentimes confuse. Ron, anything you wanted to add on survivor benefits at all?
No, I think that's great, Matt. Thank you. Colin, did we have any other questions that popped up? Otherwise, I know one of the ones that Matt and I get all the time, we can cover that too.
Yeah, what is one of the ones that you guys get frequently?
Well, I'll tell you the big one that we get, and we get it all the time. You know, we keep hearing in the media that there's not going to be Social Security benefits available long term. In fact, I just read that the Social Security Trust Fund is due to be depleted in 2034, if I'm not mistaken, Matt. I think they bumped it up a year. Is it, it's no longer 2023, it's 2024 or 2034?
34, yep.
Yeah. Yeah. And so I have a long-winded answer, but I'm not going to give all of it today. The reality of it is Colin, 50% of Social Security benefits are entirely dependent on Social Security to put food on the table and provide shelter. Congress cannot let it fail. If they do, we'd be looking at mass poverty. And so they've been pulling levers all along since the mid 80s to bolster the program. They've done things like get rid of various claiming strategies. They've increased the amount of income that's subject to FICA and so forth. And they're going to continue to do that. One of the last things that they will do, I'll tell you this, is to reduce benefits. Generally, the fixes come on the backs of those that are still working in the form of perhaps higher FICA rates or more income subject to FICA tax is probably the likely solutions there. But I don't see ever there being a risk to Social Security being dissolved. It's just too important at this point.
I'll hop in on two questions that came into the queue. Again, around spousal benefits, survivor benefits. A reminder that spousal benefits, again, if you are the 50%, you are the lower earning spouse, spousal benefits on the 50% number cannot be claimed until the higher wage, higher spouse, higher benefit actually turns on Social Security themselves. So again, if you go to file for Social Security and your spouse has not claimed themselves, they're not going to give you 50% right away. They'll give you whatever your own benefit amount is. And then once the spouse turns on their benefit at 67 or later, they'll then bump it up to 50%. However, worth noting, if you turn on a benefit early, 62, 63, 64 as a spouse, that is where you are not going to get the full 50%. Because you have turned on benefits, whether there's your own benefits or spousal benefits, early. That same sort of reduction that I talked about applies both to your own working record as well as to survivor records. The only thing that you do not get a haircut from by taking your benefit or your spousal benefits early is survivor benefits. Survivor benefits will automatically get the higher of the two benefits, even if the lower wage earner took it at 62 and the higher wage earner took it at 70. If the 60, the age 70 higher wage earner passes away first, the lower wage earner is going to get a bump up to that full 70. One last thing that I wanted to reference as well, and I think it's on the slide, but there was a comment in as well. I do think that you look at Social Security and you cannot make a decision around Social Security entirely in a vacuum. We talk about the analysis that we do, and it's oftentimes, how do I get the most from the Social Security Trust Fund? To me, the decision around Social Security is a combination of lifestyle, legacy, and longevity. Am I going to make it past break even? Does my family record, my own personal health, say that I'm going to live past 81, 82 to make more from this? Or from a legacy standpoint, is it really important for me that I leave a legacy for my children or my grandchildren or charitable causes that I support? Because you know what? Besides leaving it to my spouse in the form of survivor benefits, I can't leave Social Security to my kids. I can leave Social Security. I can leave assets. I can leave investments. I can leave IRAs. So there is that balance and that delicate balance about what's most important to you. And for some people, it is just getting the most from the Social Security Trust Fund. For others, it is, you know what? I want to balance being able to have assets that I can leave a legacy for. And I fully agree with that as well. You cannot make a decision on Social Security in a vacuum just on what's going to give you the most from the trust fund.
Well said, Matt. Colin, do we have any other questions?
So we do, but it is right at the top of the hour, so we're going to have to close out. But thank you again, Matt and Ron, for sharing your insights, and thank you to everyone who has joined us today out there. And we hope you found the discussion valuable and a worthwhile use of your time. If we weren't able to address your question, or if you'd like additional information, please reach out to your Baird contact who can connect you with the appropriate resources. For those of you who would like to revisit today's presentation or share with others, the session was recorded and will be available in approximately 1 week. And you can access this recording through your Baird advisor or by visiting bairdwealth.com. And if you're not currently working with a Baird advisor and would like to explore that opportunity, you can find an advisor near you by clicking the Find a Financial Advisor button on our website. Thank you again for joining us, and we hope you have a wonderful rest of your afternoon. Thank you.